Hello, everyone. Welcome back to the Higher for Longer show. My name is Mason, and today I'm just going to go through my daily research, scrolling through news articles and scrolling through possible indicators and just expressing my raw thoughts as to what I'm looking at and just give you guys my own insights. These are just my thoughts and my own opinions on the data that I read today. None of this is financial advice, obviously. So, with all that said, let's get right into it. So, the first article we come across here is Fed set to double its economic growth forecast after strong U.S. data. And below the headline, it says resilience may lead to fewer rate cuts penciled in for 2024. So, right from there, the thing that grabs my attention is fewer rate cuts expected. And the thing that just blows my mind is I don't know why people are so concerned about when the rate cuts come, because it's going to be impossible to nail the time frame, at least from my perspective. Maybe the dudes at JP Morgan or Citibank or Bank of America or whoever, maybe they can nail when exactly this is going to come, but I know I can't. But the one thing that I can know is that eventually rate cuts will come. The timing, in my opinion, is simply noise and something that the market is so fixated on. And I think that's something that is worth taking note of, because obviously everyone is just waiting and waiting for those rate cuts. So the pain point in that situation is the rate cuts coming farther into the future than they are ready for them to come. So obviously now we know the pain point of what could be anyone. It could be banks, it could be real estate, commercial real estate. The pain point is time. They are not prepared for the time frames that may take place when we start to talk about things such as rate cuts. So make sure time is something you are accounting for in your own personal work. The article then goes on to talk about the Atlanta Fed's projection for Q3 GDP of 5.6%, which is absolutely insane. The indicator is noted in the article to be very volatile, and it is very likely to be revised down. So obviously take that indicator with a grain of salt. I think 5.6% is quite impressive, and I really don't think that that is going to stay the case. I think that number will be revised down here in the future. The GDP figure comes out at the end of October for this quarter, so that will be very interesting to check out. The reasoning behind the belief that the indicator may come in hot is that consumer spending has been pretty strong in June and July, and that the economists believe that that is what has the potential to provide for a strong GDP number for this quarter. Later on in the article, Diane Swonk of KPMG makes a soft landing call. Let me know in the comments below. Are you in the soft landing camp? Yes or no? Let me know. I'm seeing so many soft landing calls. I wonder if that narrative is starting to be a little late to the party. We've already had the gigantic rally this year. I believe that that was the soft landing being priced in. So now I think that play has kind of run its course. You see it so much in so many articles, so many people saying that soft landing is here. I just don't know if I can buy that narrative at this point. I could have bought that narrative when prices were lower and it had not been priced in yet, but I would say the soft landing looks pretty priced in to me. I've seen people making calls. Darius Dale is one of them. I know that he has made a call for a new high in the S&P 500, either this year, probably likely at the end of the year, maybe early next year. Very interesting to see that people are making the call for a soft landing when I believe the soft landing is already most of the way priced in. There may still be some upside to that narrative. It is completely possible, but it's very limited in my opinion. Later in the article, the point is made that the tighter lending conditions coming from higher rates are likely to begin to be felt by the economy. They have not been felt yet. And that, in my opinion, is the reason that we are less likely to see a soft landing. Things got hard for banks back when banks collapsed and have only gotten worse as the Fed continued to raise even after that happened. So those tighter conditions are beginning to make their way through banks into lending. And that lending is what drives the economy. As lending begins to slow, it would make sense, in my opinion, that the economy would begin to slow. And that has not happened yet. That is why I believe we will not get the soft landing. Let me know in the comments below, though. Do you think we are going to get a soft landing, or are you thinking that the tighter conditions have not hit the economy yet? I would love to know. Please leave a comment. Next up here, we're going to talk about the services PMI. This is one of the indicators that I track in my own personal research. And the services PMI comes in at 54.5%, showing growth better than last month's reading. So a 1.8% growth. So we have an acceleration in growth for services, and this is a surprise. And this shows the hotter economy than expected. Now, what we can extrapolate from this is this would actually be a narrative, an indicator for the soft landing narrative. Because this shows that the economy is doing well, it is performing. One point we can note here is that order backlogs are at 41.8%. So backlogs are decreasing, and supplier deliveries are at 48.5%. So getting back close to 50%. But other than that, every other chart is above 50. So strong growth coming out of services, and this is a surprise to the market. Most markets today are in fact down. The S&P down 0.88%, the NASDAQ down almost 1.5%. Crude oil up, and this is another thing that I actually wanted to talk about today. Crude oil coming in with almost 1% today, 0.99, up to $87.55. This strong move in oil coming from the cuts that I believe the Saudis are enacting. It may be OPEC, but either way, production cuts for oil driving up the price, and high oil prices, high energy prices are not something that is good for economies, because obviously the more expensive energy leads to more expensive prices because it costs more to simply do things. Energy price increases go hand in hand with recessions, so we'll have to keep watching this strong oil price. I'm sure you're already feeling it at the pump, and honestly, it's not looking good for that. That seems like that is likely to continue, especially if we keep seeing cuts in production for oil is not something that the U.S. economy especially is benefiting from by any means. So now I've covered a few things today, and I just kind of want to go through and give my thoughts. Pretty much, I covered some indicators that give both sides of the picture. We have some soft landing indications, and we also have some economic slowdown indications. I personally tend to lean towards the slowdown. It just makes the most sense to me. We've had a strong year this year. It was a strong rebound and potentially new all-time highs coming. We'll have to see if that plays out, but that's just predictions from other people that I pay attention to. And with all that said, we could see the economy continue to do well. That could be the soft landing that people are talking about, but I tend to believe that there will be some sort of slowdown coming soon. Just because the biggest thing that stands out to me is bank lending slowing. As bank lending slows, you see the economy slow. It just makes sense. People are getting less money. Businesses have less money to operate. It's just all around harder, and there's less money in the system. And in my opinion, that sounds like something that would lead to an economic slowdown. As people have to really deal with these tightening lending conditions, it is likely, in my opinion, that a slowdown is coming. But please let me know what you think in the comments. I would love to hear what you have to say, and I would love to have a discussion. Thank you. Have a good day.